Hey everybody, this is Paul doing a quick YouTube video, dividend video. Today is the 15th. It is 12:32. The market is currently open, as you can see. We're in a bit of a correction right now, but that's not too unexpected given the data that's been coming in and whatnot. Um, so currently there's not too much going on in the portfolio. I just added 20 shares of BST just for the simple fact that tech has been down this week. And I wanted to hit my goal of kind of where you see right here, 409 shares to hit this dividend target right here. So this actually does shift around. So like say if this was 37, you can see how I would need less shares. So, but that's just kind of where it's at right now. So I wanted to make that rate around 100 or so just every month coming in. I'm not going to get that this month because it's after the ex-dividend date, which was the 14th. But that'll pay out next month. This month I think it's going to pay out at like 96 probably. So that's kind of where I'm at right now. As I said, the main focus obviously is still BBN. Um, and I do have some screenshots if you want to kind of get a general idea of where I am. So here's BBN. So I had 299 shares there, and this was on the 3rd, and now I'm up to 670. So as you can see what happened here, obviously, so you see the cash balance is dramatically lower. So I'm keeping my cash right in that 2,500 area, give or take a little. So the current strategy is to add to BBN from the 1st until the 14th, and then after the 14th, or actually the 1st until the 13th, and then after the 14th, add to the cash account because the cash yields 5%. So that was never really an option over at E-Trade because the place where E-Trade keeps your cash, so like this is the place where E-Trade keeps your cash, there's no yield on it whatsoever. There's no yield. You just don't get paid for your cash at E-Trade. They get paid. Trust me, they get paid. They're taking your money and investing it, and they're reporting it as net interest. But like you don't get it. So that's one of the list of reasons why I left E-Trade. So currently, what's going on? Where are we at in the market? Why are we selling off? So it all goes back to rates, obviously. So the U.S. government is still issuing lots of debt, and somebody needs to buy it, and we need to put rates pretty high for somebody to buy it. So as you can see, short end rates, 2-year rates have gone up to 4.72. We have pretty much priced out since January. There was 6 cuts priced in just about. That is now down to 2. um, and as June gets closer, unless this data really starts to turn, we might have a problem. Um, so I still think we're in a bull market. It seems pretty obvious. I mean, everything here tells me that we're in a bull market. Just from technicals alone, if you go out here, you had your high, you had your first low, you retested that low, and then you broke out above that low, and you never went past it again. And then once you broke out past the previous highs, the market pushes the price up until it hits an earnings wall. And that's what that's called. Till earnings can't support the price anymore, and then there you go. And then you get a correction like what you're seeing right now. Now, what you're also seeing is it's not just earnings, but you're also seeing the results of like the CPI coming in a little bit hotter than you expect. Services isn't going down like you would want to. Um, there's just different things that aren't going down like it's supposed to. Now, there are different things that are going to go down. So there are different things. So like, for example, if you look at, so Jay Parsons is a really good person when it comes to rental housing, like literal rental housing economist. He can tell you whatever you want to know, but you can still kind of see this extreme delay in how OER is being added in. So OER did go up in January, but it did come back down. But now we're dealing with things like auto insurance feeding through finally. Because, well, it turns out if a car gets stolen and car prices are extremely high, to replace that car costs a lot more money. Um, or if you have a supply crisis, auto parts aren't getting made, or if you got unions that are shutting down auto manufacturers, and somebody gets in a wreck, you need to replace that engine or something like that, well, those parts go up. Well, that feeds into your auto insurance. So that just came through in February, and that was not pretty. That was very ugly for sure. Homeowners insurance, that just goes back to just different things, like hurricanes, that type of stuff. All the homeowners insurance increases are coming from very specific areas of the country that are becoming nearly impossible to live in. Trust me, I live in Louisiana. Um, so we're just seeing different things that are feeding into the CPI all at the same time at a very bad time that are just causing things to get further delayed than what we would hope. So OER is obviously the big one. This makes up 1/3 of the report. BLS literally points this out every time they report the CPI, that OER makes up this huge part of what's actually going on. Like 65% of the increase is a word they keep using, or a phrase that they keep using. They literally had to explain what OER was and different OER changes. These are things that nobody cared about. Nobody cared about before 2021. You probably never even heard the term OER before 2021, but now it's like the most important term that's ever existed. It's just simply because the Federal Reserve and just, you know, guys that want rates to go up are placing so much weight on it. But as you can see, what Jay's saying here, so there's just certain people I would recommend following on Twitter if you really want like a, where's he at? I know I'm following him. He's in here somewhere. Where's it at? But it should be. I followed a guy, but I'm gonna try and find it for you because I would really recommend that you follow this guy right here when I find him. I'm looking for him still. Sorry about that. Very professional stuff I got going on here. This is his new account. I really recommend that you follow him. This is David Cervantes. Very spot on when it comes to these types of predictions, like different things that are going on. He has a newsletter and Family Money that he runs, and it's his own money, so it's not like he's like, just gambling with other people's money. So it's his own money that he does, and some family money. But 40-year professional, extremely, extremely knowledgeable, extremely, extremely nice. So his current thinking or theory is the Fed will lower as we get closer to 2%. The other side of that theory is somebody who's also become quite famous, and he deserves it too, is another 40-year veteran, Andy, who believes that the Fed won't lower until we're basically on top of 2%, like between 2 and 2.5. So there's a theory going on right now, and this is what the market is doing right now, is they're trying to game this out, is do they lower rates as you get closer to 2.5, or do they lower rates once they get to 2.5 afterwards? So that's the theory. That's what's going on right now, and the market's gaming that out. So that's why the bond market is jumping all over the place. And as you can see right now, that's how you're pricing out cuts. And as the data comes in more hot, and it's taking longer and longer and longer for things to adjust off, like OER, for example, like I said, so the longer that it takes for these two lines to meet up, because as you can see, the longer that it's taken for these two lines to meet up, is the longer that this whole thing's going to go on. And the market can kind of get ahead of itself. It's backing off. It's adding in. And then world markets are also responding to this. So like Japanese markets, for example, are probably going to see the first increase in more than a decade. When people said they probably would never be able to do that. But so I think that's kind of where we're at right now. I mean, I'm doing great. I'm not sure what I'm at today, but I'm thinking something like this right there. So just since the first alone, I've added 2,045. Probably going to say 1,800 on here once I do today's update. But in gig alone, I've piled every penny I can find into the market. So the capital gains as much probably isn't that much, but for like gig alone, I've been piling every penny I can put in. Um, just for the simple fact that where there's still tax return money out there. So you can, as you can see, the tax return money comes in as like a big, like like bunch of money. I've mentioned this before, and then that's the best time to take advantage of like different gig apps. This week's kind of looking like very similar. It's a little bit lower. You could tell people are kind of like the people that were going to spend their money have spent it, and then you have the people that save up to go on like summer vacations and stuff. So, but there's still people spending money out there for sure. So there's still money to be made. Like I said, one thing I would follow, like who I would definitely follow, is Jay Parson, who's literally a rental housing economist. I would not really listen to too many other people when it comes to OER. There are experts out there on OER, and they're posting stuff, but Jay makes it very simple to break down like what's going on, and it's very simple to follow. But this is what we're all still waiting on. It's still a waiting game. It's not going to stop being a waiting game for a while. Um, but like I said, the current plan, like I said, BBN as I get closer to these different targets that I want to hit. I have a lot that I need to add into BBN. Obviously, my next target that I'm trying to figure out how to pull off in 2024 is to get above 6 digits. 6 digits is my target, and it's not that hard to pull off if I can pile most of my gig money in. Plus, also my spouse is throwing some money my way because she has like a stable thing that she's always wanted to do now. So if I can get, so say for example, like O goes back up to where it was. I'll give you just an example of how quick I could pull this off if possible. So if they do lower rates, that's going to immediately affect my portfolio in a major way. So say if they lower rates, this would probably go back to 60 very quickly, and I'll show you what that does. So this says 75 right now. That jumps to 78 almost immediately. Um, if it went back to 82, which would be amazing, right? I'm at 84,000. I haven't added a single penny. I haven't done anything. The only thing I did was change the stock price. So if this goes back to 60, say if that happens, this would probably go back to 20. I haven't added a single penny and I'm already up to 80,000. So that's where all this additional things that I've been adding can kind of start to come around. And if that happens, that would mean BST would probably take off to say 42 again. Say if O takes off to 60, there's different things I can go on and say that takes off to 19, I'm at 82. And I haven't added a single penny. So that's what I'm waiting on, is once they cut rates, I should see a pretty significant jump in my portfolio. But we're all still waiting for OER to come down. We're waiting for the things to stabilize without a recession. You get a recession, this whole thing's off. Something would have to break right now in the credit markets that they don't respond to. And good news is they're responding very quickly. So what I'm going for is 6 figures this year. Now, how do I get there? I don't know. I'm piling money into BB, and that's pretty much all I know how to do. So that's what I'm doing right now. Um, so I think that's where we're at right now. Like I said, current waiting game. That's where we're at, and then we'll just go from there. Okay. Well, if y'all have any questions, leave them in the comment section. I'll be happy to point out anything. Y'all have a nice day. Thank you.